on what this means for market action in the new year. Let's bring in Kathryn Rooney Vera, StoneX Financial Chief Market Strategist. Kathryn, good to speak with you. And I think you just heard what Stuart was telling us about how if the jobless rate continues to hover at around 4.5%, the Fed may be forced to do more than the 2 rate cuts that are currently priced in. How are you thinking about the path of easing next year?
I agree with Stuart. I think the Fed does produce additional rate cuts. I think it depends, of course, on the labor market. And I would even say that if we push towards what I think the neighborhood is, which is about 5%, then the Fed is forced to cut more than 2. My base case is 75 basis points. I think that's what the Fed is very likely going to do. I think productivity gains are helping. But the risk, of course, Scarlett, is that you get a reacceleration in inflation. It's not my base case. But if the Fed cuts too fast, too soon, then you could get a resurgence of animal spirits. And I would agree with Stuart in many aspects, but I would probably add to his points, which is, in my view, the U.S. economy is in fact growing, and the numbers dictate this, above potential. So the risk, in my view, is not stagflation. It's not recession. It's potentially an overheating of the economy if, in fact, the Fed does deliver more than it should.
What does this mean in terms of where treasuries go, the 10-year yield, where equities go? Because Bloomberg published a story earlier this week about how strategists are pretty much all in lockstep when they are looking out to 2026. They're on average seeing an 11% gain in the S&P 500 after 3 straight years of double-digit returns. It feels like everything's already priced in. And if everything's already priced in and everyone's on the same page, that leaves us a lot of room for a big stumble.
It really does, Scarlett. And you know what happens when consensus falls like wholesale in line? It usually doesn't pan out that way. I think that the risk is equity upside. It does not rely on additional speculative excess. I think it comes from if we get lower real rates. And in fact, that I think is what will push equity markets higher. You get lower discount rates combined with continued earnings growth, which we do have. Valuations can expand because real yields fall. So if we do get real yields on the downside, not because inflation disappears, I think you can get additional equity upside. So I'm in that camp. I do think we see additional upside. Equity risk is not weak earnings. The upside risk, in my view, is growth running too strong, pushing yields higher, making the Fed perhaps not able to cut. But in fact, God forbid they have to hike by the second half of next year. That would be horrific. But the downside risk, I think, on the flip side is slower growth, more than I'm anticipating. I am anticipating, as my base case, Scarlett, a soft landing. That's that elusive thing that we were all looking for years ago. I think we're seeing that now. Guys are calling it stagflation. It's not stagflation, in my view, when you have the economy growing above potential and inflation sticky. Rates drive outcomes more than earnings collapse. Hedge yourself. Hedging works when growth slows without breaking and policy credibility remains intact. So rate volatility falls. Equity bond correlation, I expect to revert to negative. That's a very good thing. And treasuries regain their role, Scarlett, as portfolio protection.
Right, as a ballast in the portfolio. So where does that leave something like credit, which, you can take a lot of risk on if you wanted to?
Well, sure. I mean, I think if you have a Fed that doesn't cut as dramatically under not my base case scenario, but if you get a Fed that, God forbid, has to hike, then you get the weaker credits falling into, disarray. So I think the U.S. 10-year yield drifts back down to 375, 390 in 2026. That's generally a positive view. So I am in the bullish camp. But let's say that were not to happen, then I think you would get risks in the credit spreads, moving higher, risk assets taking a tumble, and guys really moving into risk-off assets such as gold. So that's why I like hedging. I think hedging makes sense going into next year, although I am generally constructive, Scarlett.
All right, Kathryn, really appreciate your joining us. Kathryn Rooney Vera. Oh, you know what? Actually, I'm told that we do have some more time with you, so thankfully we can continue our conversation. Excuse me.
Awesome.
In terms of the data points that you are watching, we talked a little earlier about how the third quarter data is ancient history. The fourth quarter data will be affected by the government shutdown. At what point do you feel like you can look at the data that comes through and really trust that it paints an accurate picture of what's happening?
I heard your question to Stuart, and I think his answer was also very, very similar to mine, which is that I think you can look at the general trends and assume that we are in a deceleration in terms of economic activity, and that's a good thing. I think that's a good thing. I think probably the markets are overestimating the impact of AI, and that worries me because I think productivity takes time. You get cash flow first, you get earnings first, but productivity comes later. So I do think that we're seeing a deceleration in economic economic activity. That's a good thing. I think inflation stays sticky between the 2.5% and 3%. And I think guys are overestimating the impact of AI on productivity. What we're seeing right now is a far cry from the 1990s, Scarlett, where we saw, the tech bubble and the like. I don't think this is a bubble with AI. I think that macro scenario this year is far different from the 90s. We have massive fiscal deficits. We have a different scenario in terms of trade. In the 1990s, we had opening trade, GATT, NAFTA, WTO, and we're quite different this time around.
Yeah, absolutely. Kathryn, really appreciate your joining us. Kathryn Rooney Vera of StoneX Financial.